Hey everyone, welcome back to another dividend investing video. Dividends are amazing, and if you can set yourself up to retire on a portfolio that pays out enough dividends that pay your expenses, you don't have to worry about running out of money. But it is important to make sure the companies we invest in are profitable companies, right? They have prudent management so that we don't incur a loss on our invested capital. And this is especially important for investors who are still growing their portfolios, who are in stacking mode, not yet living on dividends. Unfortunately, yield traps and value traps can be enticing to any investor. And I think I fell for one myself, and now I'm reconsidering my choice to be in this stock. I'm marking it as review for sale. So let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So the stock I have on review for sale is Walgreens Boots Alliance, ticker WBA. The stock has performed awful over the last decade. In fact, you'd have to go back 12 years to be made whole on this stock. Walgreens reported earnings today, and it was another disappointment, in a string of disappointments. This has become the norm for Walgreens. Earnings per share missed by 7 cents. They did beat on their revenue by $1.3 billion, but they did lower guidance for Q4 and 2024, and shares dropped almost 10% just today. But with these price drops comes dividend yield, right? Look at this chart from Simply Safe Dividends. Today, shares are yielding 6.7%. This is a whopping 70% above the 5-year average dividend yield of 3.94, nearly 4%. When I started buying it, the yield was closer to 6%. Luckily, I do not have a large position in Walgreens. I've been slowly building at $20 here and there over the last 8 months or so. I've not added in quite a few weeks. The dividend payment I received earlier this month, I did reinvest that. Now, right now, I'm down 22% on the position. I'm dollar cost averaging down. It's my worst performing position in my dividend growth income portfolio. This is the account I have with Fidelity that I'm investing in weekly here, publicly on our channel here. I do have a few worse performing stocks in other portfolios such as Verizon and UGI, but neither of those are on my list of stocks I'm considering selling right now. I've been second guessing my choice to build up this position in Walgreens ever since I started, and then with today's earnings reports just reaffirmed my thoughts that this is really not the type of company I want to be using to build my dividend income, and I'm going to show you why. Now here's a view of my Fidelity portfolio in Seeking Alpha, where I can sort some things in various ways. You need a premium membership to put your portfolio in like this, but if you guys just wanted to try it out, you can use the link in my description to get a 14-day free trial. Then you can link your portfolio in like this, and it gives you some nice information like this health score. But I'm going to go over here to the performance tab, okay? This will let me quickly see how my holdings have performed over these time periods. And I'm interested in the long term, so let's scroll over here to the 5 and 10-year performance. And I can sort these by column here. And if you look at all the holdings here, only Walgreens Boots has negative returns on both the last 5 years and the last 10 years out of all of these holdings. Even with dividends paid over the last 10 years, you would still be down about 6% on your initial investment. This has been a massive loser, and you can make the case that they're going to turn it around, but at some point they have to show that. And here is a 10-year chart. Shares are down 35.2% over the last decade. It's just been in free fall, and no amount of yield is worth that. And here's their income statement here in Seeking Alpha. Here's their income statement in Seeking Alpha. We can see some revenue growth, although over the last 5 years it's pretty stagnant. We can also see the cost of revenues have doubled over the last decade, and gross profits are also pretty stagnant, and in fact down over 5 years ago. That's not a pretty picture. Their free cash flow has dropped. Free cash flow per share today, it's actually lower than it was 10 years ago, and look how bad it's dropped over the last 5. Look, for a solid dividend growth investment, you need to see free cash flow growing. And if a company isn't growing its free cash flow, how are they going to keep growing their dividend? A healthy dividend needs to be easily covered by free cash flow. And over the last 12 months, the dividend has made up 169% of free cash flow. In the next 12 months, 71%. So it's covered, but still much higher than the ideal cap of 40% for a retailer. Because look, retailers almost across the board have low margins. As you can see here, there's not much in the way of margins for Walgreens, and that really takes away some of that security. Walgreens is also carrying a good bit of debt, more than we'd like to see, both in terms of net debt to EBITDA and net debt to capital, and with the rise of interest rates over the last decades, it's not a good place to be in. They're forking out a lot of money just in interest payments right now. In a company like this, you wouldn't expect to see much in the way of dividend growth. That's definitely been the case. Walgreens has been raising their dividend for 47 years, and they're a dividend aristocrat, but their latest dividend raise was just a nominal 0.5% raise. The dividend is set to be raised again for the September 2023 payment, but I'm not expecting much. With Walgreens, you're prioritizing high yield over both dividend growth and the preservation of your invested capital. In my opinion, the latter two items are far more important than a stock's yield. And I say this is the guy of the channel called Dividend Growth Income. Look, the growth part of that is important. So I'm leaning towards selling out of Walgreens. It's not something I'm in a rush to do. I'm going to review this over the quarter. I think I'm likely going to move on from Walgreens. And for where I'm going to put the money, that's really a topic for another video, but I could tell you I'm not going to be going into competitor CVS. And I think most likely the funds are going to be split amongst SCHD and VYM. This would knock my forward income down a few bucks, but long term I would feel a lot better about my money being in those funds. And when I say it that way, that's just a bigger reason to lean towards selling out. Well, there is a chance I'll still hold. We'll see. I'll keep you guys in the loop, okay? Let me know down in the comments what you're doing about Walgreens. Are you a bag holder like me? Are you thinking this could be your chance to get in? I gotta say, there's a lot of places along this 5-year chart you could have made that same statement and you end up losing your ass. No fun. Is there anything I'm missing on Walgreens here, guys? I'm not arguing it couldn't recover, and I don't think the business fits my investing goals is really what I'm saying. It could be a great swing trade, but that's pretty risky. Investing is risky as it is. And if you pick up nothing else, I just want to stress the importance of not chasing yield, falling for yield traps, for value traps. It's not a universal rule you can apply, but in general, a higher dividend yield means a higher risk on your invested capital. Guys, if you want to know about the kind of dividend stocks I am focused on, just check out this next video on some of the stocks I think are undervalued but manage to grow their free cash flow every year, and as a result, they grow their dividend payments. And this is where I am primarily focused for my investing. Thanks so much for sticking around. Have a wonderful day, and until next time, keep investing.